Past performance is no guarantee of future results. Content is offered for information purposes only. Unless stated otherwise, any and all individuals participating in the video are third parties that include both professional investors and individual investors who may not be licensed or certified by any institute or regulatory body. Unless stated otherwise, the views or opinions expressed may not reflect those of Seeking Alpha as a whole. The accuracy and completeness of content shared cannot be guaranteed. Seeking Alpha does not take account of your objectives or financial situation and does not offer any personalized investment advice. Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. Hey everyone, welcome back to another episode of ETF Spotlight. I'm Daniel Snyder from Seeking Alpha. This week, we are diving into the world of municipal bonds. That's the muni bond space. And specifically, we have Ben Barber here, who is the SVP Director of Muni Bonds over there at Franklin Templeton. And I'm excited to kick things off because this is a space that I'm not really fluent on. And so I'm hoping that you can really shed some light for us today, Ben. Let's kick things off around this fund. FLMI is the ticker here today, but the muni space. Let's start from the just very top level. What is it investors should know about this specific space and why certain things like the tax advantages are so appealing to investors?
Yeah, absolutely. And thanks for having me on. Appreciate it. Municipal bonds are the way that the U.S. has provided for financing for infrastructure across the U.S. for many, many decades. We're talking about, nonprofit acute care hospitals, schools, transportation deals like toll roads, and other transit systems, utilities. So there are a lot of the major infrastructure programs in the U.S. that have been financed through the municipal bond market. To access the municipal bond market, it's got to be something that is financing the public good somehow, some way. So infrastructure fits in really, really well with that. The advantage for investors is, of course, the tax exemption, always at the federal level and sometimes at the state and local level. So depending on what type of municipal bonds and where the investor lives, for example, in New York or in California, there might be advantages at the state level as well as the federal level for income tax exemption. So, the way that people will analyze the municipal market from the perspective of does it make sense for them or not, they'll take a look at the credit quality of municipal bonds, which is generally quite high, and they'll look at the taxable equivalent yield. So in other words, what you would have to get in yield in a taxable fixed income investment to equal that in the tax exempt asset class. And so for many, many people who are paying taxes here in the US, either at the federal and state level, it can make a lot of sense to look at the municipal bond market.
Now, this is the Franklin Dynamic Municipal Bond ETF here that we're talking about today. What makes it dynamic?
The dynamic nature of the fund comes from really two formats. There are two angles of risk that you have in fixed income. One is duration, that's the interest rate sensitivity of the bond investment, and the other is credit risk. And so those two levers that we can pull, both the duration side, so interest rate volatility side, as well as the credit risk side, that's what makes this fund dynamic. It's not a static fund. It's not a set duration or a set credit quality risk. Side of things, it can be dynamic on both of those angles, which gives us on the portfolio management side the ability to really take advantage of the opportunities in the market.
What kind of risk are there currently with the fund like this? Is it solely the interest rate side of things and the dynamic of that now we're seeing cuts from the FOMC meetings and they're projecting through the rest of the end of the year. Does that affect your fund specifically here, or is it more on the granular level of what's being offered through these various cities?
Yeah, it's both. And that's sort of the beauty and the curse of the municipal market is that it's a very inefficient market. It's retail, it's driven by the retail investor, right? And that's because endowments, pension funds, other large institutions, don't really care about the tax exemption of municipal bonds, but retail investors, individual investors who are paying taxes here in the US really do care about the tax exemption. And so that's your basic audience is your individual who's paying taxes in the US. As a result, the market can be quite inefficient because there aren't many institutional players in the municipal market. There's also the inability to hedge duration effectively in the municipal market, which takes out a lot of the arbitrageurs that might be involved in other asset classes. So it can be a very opportunistic market, which is great. I think that your question is a great one. What are the real risks in this fund? And they're twofold. Number one is interest rate risk. And the quick rule of thumb there is we've got lots of tools in fixed income to measure how much sensitivity of the price of a bond will have with interest rate changes, one of which is duration. That's the main tool that is used for figuring out interest rate sensitivity. So you definitely have interest rate risk in here. This is, I'd say, a moderate interest rate risk investment in FLMI, in Franklin Dynamic Beauty Fund. You also have credit risk. And so therein lies the opportunity set in the fund is, from our perspective, to be able to take advantage of interest rate changes in the shape of the yield curve, which is very important dynamic in our market, as well as changes in credit risk profile. We're looking to, obviously invest in the best possible credits we can with credit risk upside. So we're looking for credit fundamental improvement across the different sectors and the different individual securities that we're purchasing.
So there's a lot to unpack there. And I want to ask you, because you have the team over there that have been in the industry so long, you know how to evaluate these bonds as they come to market. When something like tariffs happen or a shock in the markets, how do you know how to, factor that into the duration side of this bonds, for example? And what kind of durations do you really typically focus on?
Yeah. So let's focus on the duration side of things first, and then the credit risk side. On the duration side, the average duration of the municipal market over long periods of time is somewhere around 7 to 8, maybe 8.5 years of duration. And the quick rule of thumb with duration is it gives you the ability to predict with a certain move of interest rates how much the price of your bond or the price of your bond fund will fluctuate. So the longer the duration, the more interest rate sensitivity your investment will have in fixed income. The duration sort of home base for this fund is what we call intermediate duration space, somewhere in that 4 to 6.5 year duration type space. So well short of the overall municipal market, but far enough away from the money market and cash equivalent type of investments to pick up quite a bit of the steepness of the yield curve. So that's what we view as sort of the sweet spot in the municipal yield curve, is somewhere in that intermediate-ish duration range, which is what this fund targets. Again, it's a dynamic fund, so we have flexibility to move the duration around, but most of the time you will probably see us in that sort of 3 to 7 year duration type of range, in that intermediate duration space. You mentioned some macro risks, things like tariffs or changes in the legislation. We've got a very, very experienced, long tenured, very large municipal bond research team headed by Jennifer Johnston here on our team, who's a longtime analyst here at Franklin Templeton. And their job is twofold: to look at the macro events that are taking place, either from a legislation perspective or straight, government perspective, things like tariffs, as well as looking at the micro level, looking at individual security selection analysis, which is really critical in the municipal bond world.
Ben, I want to ask you. So, obviously there's the team there, and we talked about this duration and staying on top of how all of these how all of these bonds will react to the things that are happening in the market. You have over 900 holdings in this fund. How is it you keep track of all of those?
Yeah, there are a couple of dozen main sectors in the municipal bond market. But in terms of the major ones, it's less than that. It's probably less than 10 individual sectors within the municipal bond market. Things that we mentioned before around utilities and transportation, education, healthcare, et cetera. Our analysts are dedicated to individual sectors. And so their job as a sector analyst is to be able to cover all of the deals within those sectors and have a very strong opinion at the individual security selection level as to the creditworthiness of a specific bond. Not all bonds are created equal, and the municipal bond market has over 50,000 different issuers that are involved in the market. So it's a very, very large market from that perspective. We use technology very, very importantly in our process to be able to take a look at the entire market and have very good opinions across the entire spectrum. not just deals that we own, but deals that are out there in the market that we could potentially take a look at in the secondary market, for example.
Now, this fund's been paying out dividends since the year it was launched in 2017, it looks like, and with a trailing 12-month yield of about 4% or so. But you've been growing the dividend over time. How important is that to you and the team to have this fund continue to grow that dividend within this space for investors?
Yeah, I think it's very, very important. And the key to that, north of 4% type of dividend or distribution yield is thinking about that on a taxable equivalent basis. So in other words, what an investor in the US would have to get in a taxable fixed income instrument to equal this. And it's well over 7%. For some taxpayers out there, it might be over 8%. So it's a very, very powerful income generator for investors out there. So the idea of growing the dividend is very important. Of course, that's going to be very reliant on what the overall rate environment is doing. But it's been a very good environment for us, over the last couple of years.
Yeah. So we keep going back to rates because I think it's so important, especially now with the administration calling for massive rate cuts right after the fastest rate hiking cycle that we've had in history, right? So your fund might see a little whipsaw. Is the cut more beneficial than the hike? Help us understand that a little bit better if there is a dramatic change in rates going forward.
Yeah. Well, as we all know, rates are inversely related to the price of a bond. So when rates go down, bond prices rise, and same thing happens in reverse. If rates are going up, bond prices are falling. So a year like 2022, when rates were increasing quite a bit, that was a really difficult time in the fixed income markets where bond prices were falling quite a bit. For those of the investors out there that have taken a look at lots and lots of different cycles, they'll remember that thinking through fixed income markets at the end of 2022 and investing in fixed income markets at the end of 2022 has been massively profitable, right? We have a big interest rate rise, bond prices fall quite a bit, and it can be a fantastic opportunity, especially in the municipal bond market, which is exactly, what's taken place. I think, one of the most interesting elements of the rate environment when we sit around our desk and think about interest rates and debate where the market is and where we think the market's going, we of course talk about the FOMC. How is the Fed situated? How have they communicated to the market? What has the market understood with their communications? How is the 10-year Treasury yield situated relative to that? And then we very importantly get into how's the municipal market relative to the Treasury market, because we're always going to be based off of the Treasury market, but the muni market doesn't move tick for tick with Treasuries. It'll tend to lag both on the upside and the downside. The other critical component is the shape of the yield curve. As we know, over the last couple of years, we've had inverted yield curves here for a while, and it really incentivized investors to stay in cash and cash equivalents money markets. A lot of money flowed into money market investments over the last couple of years. As the curve has regained its more normal shape and is now again upward sloping, and then municipals, it's actually significantly upward sloping. That has definitely motivated investors to move from cash and cash equivalents into the fixed income world, especially into the investment grade fixed income world. And munis is a big recipient of those dollars coming from money markets pushing out the curve a little bit. And I think that'll continue. I think there's a very positive technical environment for the municipal market as more money flows from money market investments out the curve into investments like FLMI, because the yield pickup is now quite attractive for investors.
I was going to actually ask you that to wrap things up here. So looking forward, you're saying that you're going to see this continued kind of turn out of money market funds and into spaces like the muni bonds like yours. But, that's healthy supply, healthy demand. But what is that thing that investors should keep in the back of their mind going, if anything was to derail the muni bond space, it could be this? What do investors need to keep there in the back of their mind as they go to look to invest in this space?
Yeah, I think the biggest risk for the municipal market is always, will tax exemption, that great benefit of tax exemption, could that be taken away from municipal bond investors? And over lots of different government administrations, that's been debated. It's never gotten that much momentum, over decades, because of course every governor and every treasurer across the country will come out fighting really, really hard to maintain tax exemption for municipal finance. It's what, again, finances our public infrastructure. So you want to have that benefit for public entities. That's your number one risk, though, with regard to the municipal bond market is, could tax exemption be taken away? If it were taken away, then the next question is, are all the muni bonds that are outstanding grandfathered into their tax exemption, and it would just be an ongoing thing? Or could you just take the entire market and make it taxable? We think there's a very, very low risk. But that's probably your number one risk. Outside of that, when you think about credit risk, you think about what are the things that could impact large sectors in the municipal market. And that gets very difficult to try to analyze. The municipal market has always been one of massive diversification. As I said earlier, 50,000 different issuers, and they all do have individual security selection and therefore credit fundamental stories to them. So it's very difficult to think of big topics that could impact the municipal market from a credit fundamental perspective in a very negative way. They tend to be very individual type of sectors.
That's a very great point. I'm glad you mentioned that, because that was one thing that I didn't really keep front of mind and in our conversation is if they lose their tax exemption, which with the national debt going out of control, anything's possible, right? So hopefully it doesn't happen anytime soon. Ben Barber, thank you so much for the time today. Really appreciate this dive into the muni space, helping us understand this better. Everyone, this has been another episode of ETF Spotlight. Please go check out this ETF here on Seeking Alpha. That's FLMI. Add it to your watch list. Maybe it's right for your portfolio if you're looking for that tax exempt income going forward as well. And we'll see you here next week. Take care, everyone.